only mode.
Hello and welcome to today's premium account market update for November 2015. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation or offer presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. Presented today, myself, Leon Hine, Managing Director of Investor Signals. I have 17 years of experience in the financial services industry and a current licensed securities and derivatives advisor. The format for today's presentation: a quick summary of the macro update driving equities. We roll through the ASX top 50, particular focus on FES 16 earnings outlook, and a summary of the technical trends that we focused on in the previous recording. And we conclude with a short-term portfolio or market outlook and portfolio allocation summary. The Investor Signals Premium Account Service is a model portfolio of ASX 50 stocks. We utilise call options to enhance portfolio returns. We focus on effective ownership around ex-dividend dates, generating above average cash flow, capital growth, all under a strict investment mandate, and importantly, the assets remain in your name. If you'd like to know more about the Investor Signals service, please contact me, Leon, at investorsignals.com. Moving straight into an index of the top 50 stocks. Now, the index on the graph here sort of puts into perspective the magnitude of the sell-off that we've had here in the Australian market, and it's really been out of kilter a little bit with what's happening in the rest of the world, considering the US has continued to perform strongly from its recent sell-off a month or so ago. The Australian market, I think, in part, obviously, we've seen BHP under pressure and the Australian banks, which is a big part of the index, and that's weighed on the market. But as we roll through the top 50 stocks, we'll look at the forward earnings growth expectations of the top 50 stocks, tie that in with the dividend yield, and try to look at the technical picture. In the last recording, I spent a bit of time focusing on the contrast between that earnings outlook and what the technical picture was telling us. So we remained fairly cautious in client portfolios over the last month or so, and we were aggressive with selling calls to drive an extra capital growth. Now what we're seeing, and the focus really in that last recording, was that the market or a number of stocks were breaking down to create lower lows and lower highs. I've gone through all the charts for this week's or this month's recording and really tried to highlight these technical structures for us to focus on. At a macro level, as I start to roll through the top 50 stocks, in the US we've seen better employment numbers out on Friday night, which has the market thinking that there's a high probability that the Fed will increase rates in December. The general consensus is that as Europe starts to recover a little, America continues to perform well, and probably the target is for about 150 basis points, or about 1.5% increase in US interest rates over the next 18 months. So it'll be interesting to see how the share market responds to this first potential rate rise in December. Domestically, I think from a valuation standpoint, our market has had a sell-off from around sort of, just in the last few weeks, from 5,300 back to around 5,100, puts our market on about 14.5 times forward earnings, close to a 5% dividend yield. I think the argument is there's value starting to appear again. Up on screen at the moment is AGL. My view here hasn't changed. The stock's going to trade sideways for another 6 months or so, but ultimately putting in a floor here. The company should deliver about 7% earnings growth, puts the stock on about a 4.5% dividend yield at the moment. Anything sub $16, so a pullback to around 15.50, 15.75, I think is a good buying opportunity for AGL. Asiano, we've seen Cube come back just overnight and trump the offer from Brookfield, so it looks like 9.25 is the offer that's on the table. Asiano's been a stellar performer off the back of the takeover speculation or the takeover competition between Brookfield and Cube Logistics. Amcor, a name that we like in portfolios, continue to hold this. The company's reaffirmed earnings outlook. I think the number's probably slightly at the softer end, had been tracking close to 10%. I think the number on a constant currency basis is probably somewhere closer to 6% into 2016. Even on that basis, it puts the stock on a 4.5% dividend yield. We were pretty aggressive just in the last week when the stock rallied up. We sold the 14.25 calls into January. We got an extra 25 cents for those, so we expect that to probably not get exercised, and we'll collect also the extra dividend in in February. So we're generating about 55 cents of cash flow off Amcor really across the next 3 or 4 months. So that's more than doubling that yield. So generating close to 10% cash flow off Amcor. And that fits in with my theme or thesis that I've repeated over the last couple of months of recording is Amcor's a great stock to hold in portfolios. Just don't expect this same type of capital gain out of it like we've enjoyed over the last few years. I think it's an environment that it moves sideways, forms a base, and maybe we can see it push higher into the middle part of next year. But short term, I think sort of around 14.25 captures the upside growth there for Amcor. AMP delivered okay earnings, result about 10% underlying earnings growth. The stock's just on a 5% dividend yield, but again, negative price structure here. So we're looking at other opportunities in the market that are more compelling. ANZ, we've just started adding this back into portfolios today. I think ANZ and NAB offer good upside potential over the next month or two. If you go back to my prior call on the banks, when they were trading at these levels, I said expect a bounce of about 5%, but don't expect anything more. And that's pretty much what we had when you put that in percentage terms. ANZ was trading around $27, so roughly $1.50 on top of that, $28.50 pretty much was where it ran into resistance. So if you go back and look at the last recording, and I highlighted that about a 5% bounce was what we're expecting in the banks. I think now's the time to get aggressive, and ANZ looks good value down here. Again, still on a counter trend bounce. I'm not looking for it to rally much more than around back up to about $28 over the next sort of 2 to 3 months, and we'd look to lock in profit again. It's not until it forms a base that I really sort of start to take a longer term structural view that it's worth holding ANZ on a 6, 12, 18 month outlook. But right at the moment, I think there's a trading opportunity for it to bounce back up again about 5% or so from where it is at the present. APA Group, I think this is one of the few stocks that's got a bullish structure still in place. The company's delivering good underlying earnings. The stock's on about a 4.5% dividend yield, and certainly the trend's the friend there on APA. ASX, so we've locked in profit here simply because the structure's negative. It's not really that I don't like the ASX business. It's growing about 5 to 6%. The stock trades on about a 4.7, 4.8% dividend yield. The issue here is just simply from a technical perspective. It's broken down, create a lower low, lower high. If we get an opportunity to buy into ASX sub $40, happy to jump on that again in the coming weeks. AZJ, this is one of the names that we've stayed long or stayed exposed to on the long side. The company came out with slightly disappointing haulage numbers for the September quarter, but reiterated that they're likely to increase their dividend payout ratio. And as I've alluded to, that underpins the performance of AZJ. Currently, it's on a yield of about 5%. We could see that pushing up to about 6, 6.5% over the next 12 months, even with limited revenue growth. Good cost control at the cost side level for the company. The strategy here is we own it, and we've been aggressive selling covered calls. So again, because of that deteriorating revenue picture and the discipline needed on the cost control, I don't think it's worth getting excited on the upside potential, but to own it here and sell covered calls, we're driving 10% cash flow out of AZJ. BHP, so we've seen a horrific accident occur in their mine in Brazil that's going to probably weigh on the sentiment towards a BHP. I don't see a prospect over the short term for BHP to do much more than at best trade up to around $24, $25. But I think that's only if we get into a strong period in equity markets from November through till January, or from December through till January. So the technical picture here with BHP is we've certainly got a lower structural high, and the pressure seems to be to the downside still at the moment. Brambles, so we like this name. We owned it at lower levels. We've been aggressive, either taking profit just recently at around 10.70, or we've sold covered calls aggressively into March, where we're hoping to lock in the March dividend as well as the call premium. And if that's the case, it gives us an effective exit price up here around $11. My concern here with Brambles is we've got a negative structure in place. the stock's compressing down to a dividend yield of about 3.5%. So I don't see, on forward earnings growth of about 6-7%, I don't see the capacity for the stock to trade too much higher than where it is at the moment. CBA, look at these levels, I think the bank's a good value. Arguably, probably ANZ and NAB have been oversold more than CBA and may actually offer a bit better short-term bounce. Coca-Cola, companies slowly returning to earnings growth. The market's still looking for further reassurance. 5% earnings growth, 5% dividend yield. The stock's okay value. We've been aggressive and sold covered calls over Coca-Cola to drive the extra income. Computershare, disappointed during earnings season result. The market was looking for something around 5% earnings growth. They delivered, from memory, something in the order of negative 10 to 15%, and that was really responsible for this big collapse in price from $12 down to $10. Our strategy here has been to get aggressive with selling the covered calls. We've sold calls at around 11.25 on the top of this rally, and again that boosts the dividend from about 3.5%, getting close to 10% cash flow out of Computershare. I don't think the stock does anything more than trade sideways, and I highlight there's a negative structure in place there on Computershare. CSL continues to really outperform relative to the rest of the market. Underlying earnings growth about 7%. The company's announced another $1 billion share buyback, which will begin soon. At $95, the stock is looking a little bit expensive on a 2% dividend yield and trading about 22 times earnings. But any pullback to around $90, I think, is a buying opportunity in CSL. We owned it at lower levels, and we've now taken profit. So we had sold the covered calls over it. They wound off, so we collected the premium from those calls and we've sold the stock. So our effective exit price here in CSL is pretty close to this $95 level. We'll wait, look for a pullback to around $90 and then take another look at CSL. Caltex not doing too much here at the moment, albeit continuing to review research and the earnings details and data on Caltex. A little bit cautious of the negative technical structure in place, but the stock's certainly on the watch list and we're starting to take a closer look at it. Crown Casino, the numbers out of Macau still remain negative. We saw James Packer at the recent shareholders address highlight the need for Crown Australia to have a closer focus on its return on equity, which really I think is a sign that they're going to become more disciplined on cost control and really look to invest a bit more heavily into the Australian assets. As you'd expect, Perth is underperforming. Crown Melbourne is the jewel in the crown at present. They've got ongoing property development opportunities that pursuing at Crown in Melbourne. Obviously, we've got the Barangaroo site in Sydney, which is slated to maybe open around 2020. The Philippines, City of Dreams Casino opened a few months back, and the early data out of that's actually starting to look okay. But Macau continues to weigh on the earnings. The stock trades about 3.5% dividend yield. Hard to get a handle on what the forward growth numbers look like, subject to what happens in the Melco contribution, which Melco contains the Philippines business, and Macau. I think if we have to sort of look at where the earnings sit for it, I have the stock probably likely to deliver somewhere around 75 cents of earnings per share. Now that puts the stock at about 16 times. So it's on the radar. It's had a pretty significant sell-off, predominantly off the back of the lower earnings contribution coming through from Macau. But I think it's certainly worthy of starting to keep this one on the watch list now at these levels. Not to think they're in Dexus. Goodman Group, I highlighted that it was good value at $5.50 at best. It's just fair value now. At around 4% dividend yield, don't see it compressing too much more. GPT, this has been our preferred property play on a bit over a 5% dividend yield. When it rallied up to these levels, we've been aggressive and we've sold the $4.70 calls. We got good premium for those. And again, it pushes that cash flow from about 5% up to something closer to around 10%, as well as allowing for some capital growth if we do end up delivering the stock. Insurance Australia, we've seen them pull out of their investment in China, which was the catalyst for this rally from around $5 up to $5.50. When the stock was trading down here at around 5, I'd mentioned that fair value was back up to around 550. I think we're there at the moment. The stock trades sideways. We've got aggressive and started selling covered calls over our holding now in IAG. IPL, I haven't had a chance to go through the numbers, but the earnings result came out today. It looks like the company's delivering inline earnings growth. I have the stock trading on about a 3.5–4% dividend yield. We own it at lower levels. We've sold the covered calls at 360. We got around 20 cents for those, so we've got an effective exit price at the end of this month at around $3.80, and that's really where the stock's sitting. So the IPL strategy is playing out. James Hardie, again, one of the few stocks that has a bullish technical structure in the market, and maybe there's a view that keep it on the watch list and there's a buy on the dip opportunity there. Lend-Lease, I think this is getting down to compelling value, 5% dividend yield. I think the company can still deliver somewhere between maybe 7 to 10% earnings growth, and I think this might be one that surprises on the upside when we get into the February earnings results. Medibank Private, again, we own this at lower levels. We've been fairly aggressive selling either the $2.40 or the $2.50 covered calls over Medibank. Combine that with a dividend, again, we're pushing that yield up closer to 10%. I think, again, at $2.30, the stock's okay value. At $2.50, it's expensive. It spends the next 6 months mostly trading sideways within that range. Macquarie Group continues to deliver solid earnings growth. Nearing on close to $2 billion forecast profit. The stock trades on a dividend yield now of about just under 5%. I think with a recovering Europe, there's an ongoing argument that Macquarie probably deserves to be on the radar. NAB is where we've started allocating capital today, as we did with ANZ. I think these represent okay value, and we're expecting a bounce over the next say 4 to 8 weeks in the banking stocks. Newcrest Mining, after getting their production levels right and seeing it return up to around 2.5 million ounces of gold a year, just in the last few weeks we've seen them come out and disappoint with their production numbers, and that's largely been the cause of this sell-off. We just need to be a little bit careful on how gold prices behave in the face of rising interest rates out of the US. I think that's probably been a bit of a double whammy, the strong employment numbers and in the US, which would suggest that there's going to be an interest rate rise, and the lower production issues that Newcrest have seen this sort of substantial sell-off. From a technical perspective, we're coming into a higher low formation here, which would suggest that they'll start to get a bit of volume building and maybe a little bit of price support there in Newcrest. Origin Energy, look, down here at $5, I think this stock looks okay value. Obviously, Origin, Santos have really had their issues trying to retire debt, raise capital. Origin's finished its rights issue, raised around $2.5 billion at $4 a share. I think it only probably gets that debt level down from just over $10 billion to maybe something around $8 to $9 billion. So they've still got a long way to go. But the encouraging thing there is the Gladstone LNG project for both Santos and Origin is starting to deliver returns. More so for Santos than Origin, but Origin certainly not too far behind with shipping cargo, LNG cargo, in line with Santos. I reckon not doing it there at the moment. The technical structure is quite negative there. The company's struggling to grow revenues, having trouble controlling costs. It's on a 5% dividend yield. I think the pressure's still to the downside for Orica. Oil Search, this is well supported off the back of Santos's bid at around $7.50. We've spoken about the need, Woodside Petroleum's bid for Oil Search at around $7.50. I've spoken about the need that probably that needs to be lifted to around closer to $9.25 maybe to really clinch a deal. At this stage, it's unknown whether Woodside comes back with a higher offer, but I think just the fact that that's sitting there underpins Oil Search. And for that reason, it's probably a reasonable risk reward as a buy right at these levels. QBE, one of the few stocks with a bullish structure. Higher interest rates in the US will help to deliver better returns for QBE, but that aside, the company's cleaning up balance sheet, improving insurance margins, and probably should continue to push a little bit higher from these current levels. I have QBE trading on a just over 5% dividend yield and should deliver earnings growth, maybe somewhere in the order of 10%. So worth having that one on your watch list as well. Ramsay Healthcare, very expensive up here, 27 times earnings on less than a 2% dividend yield. And I think it's simply got a period where it has to trade sideways. Rio, there's an argument that maybe Rio and Fortescue could be a minor beneficiary to a slight disruption in iron ore production as a result of the issues that BHP face through the mine collapse in Brazil. I don't know that it flows through to a significant earnings uplift or re-rating in the stock, but I think probably there's an argument that Rio represents okay value down here, and whereas maybe prior an exposure to BHP made sense, I think a balanced exposure to both Rio and BHP is probably the better way to play the resource sector at the moment. So Rio comes onto the watch list as a buy right at or near these levels. South 32 not doing it there at the moment. SCG got very expensive here. So Centre Group now trading back at about 5.5% dividend yield, which is about where I think fair value is around $3.90. So we owned it at lower levels and we sold the $3.90 calls. The stock should pay a dividend of around 21 to 22 cents. On an annualized basis. Seek not doing too much here at the moment. We've seen the company miss on the earnings side, and we're really waiting to ensure that that February result doesn't disappoint again. And as I've gone through these stocks, you can see how many of them have actually this negative price structure here. So quite a few of them I've highlighted the lower high pattern, the red circle to indicate the downward pressure on the price. And in the case of Stocklands, the way we're offsetting that is we were very aggressive with going out and selling the covered calls over Stocklands at around the $4 level. We collect the December dividend. We collected around 12 cents for the call, so we're getting about 24 cents of cash flow for a 6-month period, or roughly a 5-month period of exposure to Stocklands. I think the stock's okay value here. In last recording, I spoke about how management's starting to retain earnings and not pay out 100% of the earnings in dividends. I think it's a healthy thing for the company to strengthen their balance sheet. And the company should deliver about 6% earnings growth. So I see Stocklands is a reasonable consideration for property exposure at these levels, but again, only with complementing that through the covered call strategy. Sonic Healthcare, we own this at lower levels. We've been aggressive with selling the covered calls at around 19.50, so this has been a good contributor to portfolios when a good part of the market's been moving lower, and we've enjoyed these rises here in Sonic. Santos, we've seen them finally come out and bite the bullet today with a fairly substantial rights issue, raising around $2.5 to $3 billion, just under $4 a share. I'll need to double check. I think maybe between 325 and 385, I think, is the number that they're raising the capital at. So highly dilutive, but addresses, I think, the balance sheet issues for Santos, and we really just have to wait and see where it settles, and I'll provide more commentary around Santos in next month's recording. Suncorp, the insurance business here is actually contributing quite well to the earnings, albeit margins are forecast to be fairly flat over the next 12 months. The company should deliver about 92 cents of earnings per share, puts it on now close to a 7% dividend yield. So again, we own it at lower levels, but we have been aggressive with selling the covered calls and driving that extra cash flow out of Suncorp. I think it largely moves sideways, but certainly if we get an environment where equities push higher into December, January, I think Suncorp could trade back up to around close to $14. But again, I highlight it's just another stock within the top 50 that have this negative price structure at the moment. On the other hand, Sydney Airports, so this was the bullish formation here in Sydney Airports. It'll be interesting to see if we get another sell-off and a further buy signal occur. But happy to have a look if we see it back down at around sort of $5.70 to $6. And I have Sydney Airports trading on a yield of just over 4%. So in theory, it shouldn't compress too much below that. Transurban, so we've seen an example here. As soon as Transurban got up to around a 4% yield, it's really struggled to push behind too much higher than that. And I think that's really sort of the threshold at the moment for relatively low growth stocks. You're seeing companies like CSL, for example, that's growing earnings close to 10%, the yields are compressing down to 2%. But broadly speaking, 4% seems to be a bit of a threshold that the market for these low growth stocks. So we've seen Transurban run into resistance at around $10.70. It comes into its December dividend, which will be a payment of around 22 cents a share. Our strategy has been to own it at lower levels, but we've been pretty aggressive. We're selling the 10.25 calls over Transurban, and again turning that sort of 4-5% dividend yield into something closer to 10%. And I think the story here is that over the next 6 months it largely tracks sideways, probably still with a slight bias to the upside, given that the company is forecast close to 10% dividend growth over the next year or years. So in the case of Telstra, this is good value back down here at around 5.25. I think it's a buy. So along with ANZ and NAB, we're back in the market today buying Telstra. It's on a 6% dividend yield. I think coming into the February dividend, the price can strengthen. Westpac has held up relatively well. It goes ex-dividend tomorrow, so probably a lot of money staying exposed to Westpac ahead of the dividend. It'll be interesting to see how it performs after. I don't expect Westpac to have that same volatility that ANZ and NAB have had, but equally I think it's probably not going to have the same percentage rebound over the next 6 to 8 weeks either. But Westpac probably the highlight of the banking results, earnings growth somewhere around that 3 to 6% range, which is certainly better than the numbers that we saw come out of ANZ and NAB. Wesfarmers, I think, just in light of the lower margins that Woolworths has suffered, Bunnings is doing extremely well within the Wesfarmers business. Maybe there's some concern that Coles can't maintain the earnings growth that it has had, and we've seen a slight adjustment in the price of Wesfarmers. Again, another technical pricing structure here. Wesfarmers trades on about a 5.5% dividend yield. We were fairly aggressive with selling the covered calls over this name as well. I think the stock can probably trade back up to around $40.50, but I don't see it doing too much more than that. Westfield, we own this one at lower levels. We've been fairly aggressive with the $10 calls, turning a dividend yield of around 3.5% into closer to 10%. We achieve roughly around 20-25 cents for those call options, so an effective exit price on Westfield at around $10.25. Any pullback back to around $9 to $9.25 I think is a great buying opportunity for Westfield. Woolworths down at these levels is starting to look okay value. We've seen the company clear the deck, so to speak, with forecasting to the market that they could see up to a 35% fall in earnings. And I really think that's a case of having to write down and create realistic market expectations before a new CEO is announced for Woolworths. So I would think we're probably only maybe 8 to 10 weeks away from seeing a new CEO announced, and all the things that I've spoke about in last month's recording still apply in respect to the Masters franchise. At these levels, it puts a stock on about a 5.5% dividend yield. That's on the assumption that the company can deliver about $1.70 to $1.80 of earnings per share, and I think that's still achievable. The upside potential still probably doesn't exist much more than a rally back to around $25 to $25.50. If there's the announcement of the right CEO, maybe we see that compress back down to about a 4.5% yield. But I still think you're probably in a situation where Woolworths really just tracks sideways across the next 3 to 6 months. But for new money that's available, I think there's still a compelling argument that's worth doing a buy right at or near these levels. And then finally, a quick look at Woodside Petroleum. In this case, it's trading about 4.8% dividend yield on the assumption that the company delivers about $1.60, $1.70 of earnings per share. That would mean that we could see the dividend ratcheted back a little in Woodside Petroleum in the 6 months or so ahead. And our strategy here, to the extent that we own it, has been to be aggressive with selling the covered calls. It's another name that has a fairly negative pricing structure there in the market. So I think the theme to pick up from today's recording really is just the high percentage, probably something in the order 80-90% of companies have this fairly negative technical pattern occurring in that. And I think for that reason it requires some caution. That was the underlying principle for us being aggressive with the covered call strategy, not looking for much in the way of capital growth out of portfolios, and protecting a lot of positions by selling fairly tight at the money calls. Most of those have expire around this November to December period, and to the extent that new cash is available from stocks that we've delivered, such as CSL as an example, we're starting to rotate that capital back into names like ANZ and NAB, with the anticipation that they probably have greater recovery potential if the market does bounce off this current oversold level. Thank you for listening in, and if you'd like to know more about the Investor Signals account service, or in general just to have a chat with me about the strategies or ideas presented in the recording, please contact me using the details on screen.